We all know that the Stanford Contributory Retirement Account, also known as the SCRP, offers great tax advantages for saving for your future, with pre-tax and after-tax options. Now we're excited to add a Roth 403b to the plan, so you can create tax-free income in retirement. When you save with Roth dollars, you're still saving the same amount in your workplace retirement plan, but with Roth, you agree to show that contribution as taxable income in the year earned. In exchange for giving up pre-tax savings, all withdrawals in retirement are income tax-free. Now remember, we are talking about Roth 403b here, not Roth IRAs. The two accounts are just named after the same guy who initially invented Roth IRAs, Senator Roth. Here's a great example to illustrate the power of Roth. There's a compounding guideline where savings may double every 10 years. Now, this isn't a guarantee, but a good rule of thumb. Now, let's say we have a saver in their 20s who deposits $10 into their workplace retirement plan. This person will likely not retire for another 40 years. That means that $10 deposit has time to double 4 times. So, $10 grows to 20, 20 to 40, 40 to 80, and finally 80 to 160. It's that last double that is the most fun. Now, you might be wondering what this has to do with Roth. Here's the tie-in. If this saver elects pre-tax, they are getting a tax breaks on the $10 they save, but all $160 is considered taxable income in retirement. Or they can elect to show that $10 as income in the year saved so that all $160 is available tax-free when withdrawn. So, should this person pay tax today on $10 or later on $160? That is why Roth 403b tends to be best for those with a lot of time for tax-free compounding. While the upfront tax break has always been one of the most attractive features of saving in a workplace retirement account, a Roth account that allows for tax-free compounding of all earnings could end up being an even better deal. There's a couple of other differences where Roth 403b really shines. All SCRP accounts face required minimum distributions when you terminate employment with Stanford or reach age 70 and a half, whichever is later. You can eliminate this requirement for your Roth contributions if you transfer your Roth 403b into a Roth IRA at retirement. And your kids will love you too, because Roth accounts pass to loved ones income tax-free. In pre-tax accounts, your heirs still must pay taxes as they withdraw the assets. Many Stanford employees already contribute after-tax dollars to the Contributory Retirement Account, also known as CRA. So how is Roth different? In the existing CRA, your after-tax contributions are not taxable at distribution, but the earnings are. With a Roth 403b, neither the contributions nor the earnings are taxable at distribution. There are some other key differences and advantages to having both after-tax options available, so if you already have an after-tax balance in the CRA, you may want to learn more about how to leverage both. So why wouldn't you take advantage of the Roth tax treatment for your retirement savings? Saving with Roth reduces your take-home more since you are having taxes withheld on a larger amount each paycheck. Also, Roth isn't as appealing for folks who don't have much time left to work since there isn't as much time for tax-free compounding. Also note that your Roth distributions are not matchable at Stanford. You still have to contribute at least 4% in CRA pre-tax or after-tax to receive the maximum 5% matching contributions from Stanford. Therefore, you might wish to save anything above that with Roth tax treatment to build this valuable resource of tax-free income. So who should save Roth? If you're just starting out, you have plenty of time for tax-free compounding. Plus, you might be in a lower tax bracket now. With the expectation that you'll be in a higher tax bracket as your income increases, saving Roth now makes sense and sets you up for many years of tax-free compounding. Roth also makes a lot of sense if you want to diversify your tax treatment. Most workers today would benefit by having both Roth and pre-tax savings at retirement. This puts you in control with how much you show as taxable income each and every year in retirement because you decide from which account to pull. Roth accounts aren't right for everyone, but many should consider it. To learn more, visit cardinalatwork.stanford.edu/Roth.